Welcome to what I feel is the most important lesson from this entire course. It is impossible to be a consistently profitable trader without a sound risk management strategy. This lesson and this lesson alone is worth the price you paid for this course, if not way more. You can be the worst stock picker in the world, but if you take great care to limit what you risk per trade, you could still be a profitable trader with a much smaller win rate than you would expect. For this very reason, I want you to watch this lesson through one time before you take a single note. Then I want you to watch it again and then take the necessary notes. Then I want you to watch it again for the third time to make sure you fully connect and understand how important risk management is to get right. And when you have completed all the lessons at the end and you learned all the trading patterns, I want you to come back and I want you to watch this lesson one more time. I can give you all the perfect trades to take, but if you don't practice good risk management, nothing, and I mean nothing, can save you from the most perfect trade without good risk management. So first things first, we are not day traders. We're not swing traders. We are risk managers. Let me repeat that. We are risk managers. Every single trade we take, we must always manage our risk. It's our number one job in trading. Our duty is to limit our risk when the market is down and increase our risk when the market is up. Our inability to manage risk is the number one reason 90% of traders fail. So successful traders, they think about risk, right? They think in terms of risk. Gamblers, they only think about how much money they can stand to make off a trade, right? They only think about profits. We have to always be aware of how much money we're risking on any given trade. Are you using a mental or a hard stop? Remember, I said earlier, most advanced traders, they can use a mental stop, but it takes great discipline. Using a hard stop loss takes away the ability for you to hold on to a losing trade. So we also need to ask ourselves, how much are we willing to risk on this particular trade? What's the max amount you're willing to lose on this trade? What's your max loss amount for the week or the month, right? So when I say what's the max amount you're willing to lose, how much can you lose in a day before you feel like you've had a bad day? How much could you lose in a week before you feel like you've had a bad week? How much can you lose in a month before you feel like you've had a bad month? Listen, the one thing most traders fail to realize when they get in this game is that you're going to take losses. You could have the most perfect setup. You could have the most perfect pattern. You could have the most perfect position sizing, and there's no way this trade's going to lose. And then it's going to lose, right? Because whatever. The Fed chairman comes out and says something stupid, and then the market reverses back and it takes everything else with it, right? So it happens. It happens a lot. It happens to me almost on a weekly basis. I think, man, I got this trade is going to be awesome, and that's kind of how we would look at it. We look at how much we're willing to lose. So in the beginning, most traders will start small, like they'll risk $25 on a trade. And that's great because, again, you're going to have to take a lot of losses. You're going to take $25 losses here and there. You might go up to $50 risk on a trade. You might start losing $50 a trade here and there. But here's the thing is that you start small with your risk, and when you prove that you've mastered the pattern, then you've earned the right to increase that risk. If you take a $25 risk on a trade and you lose $25, that same trade, if you would have risked $200, you would have lost $200, right? Especially if you're following the patterns that I'm going to show you. And we always need to be seeking a 2-to-1 reward to risk ratio. When I say 2-to-1 reward to risk ratio, that means for every dollar we're risking, we got to make two back. We've got to make two back. And you'll see why this is so important to do this later on. So before we can manage our risk, we need to be aware of the types of risks that are out there in the market. So first off, we have exposure risk, we have float and volatility, we have the distance from the stop times the share size versus our profit target, the halt risk, the fear of preventing us from following our trading plan, the impulse to double down, revenge trading, follow trading, which is taking trades from social media or chat rooms, and improper position sizing. So when we talk about exposure risk, your risk is calculated by the amount of money you have in a trade multiplied by the amount of time you're in that trade. As day traders, we can mitigate exposure risk because we hold stocks for a short period of time. Remember, a day trade is a trade that we open and close on the same day. Sometimes we can hold it for as little as 5 minutes, all the way up to 3 or 4 hours. But as long as it's closed in the same day, it's a day trade. The way we look at a stock and we evaluate its potential, it changes from the way we would look at the stock we plan on holding for days, weeks, or even months. On average, we try to keep our exposure risk to 30 to 60 minutes unless the stock is trending up or trending down. We're always looking for signals to sell if we're longing and also to cover if we are shorting. Okay, so let's talk about float and volatility. As day traders, we love volatility. We need stocks to move up or we need them to move down. We don't want them going sideways. These stocks generally have lower floats under 100 million shares, sometimes as low as 1 million, right? The lower the shares, the lower the number of float, the more volatile the stock can actually be. Increased volatility also means we have increased risk. If we're buying stock that's up 50% from the previous day, we're buying it at an extreme premium. Sometimes the price spread is crazy huge, right? It could be anywhere from 80 to 90 cents. If your pattern calls for you to put your stop loss right under the 90 MA and that's only 20, 30 cents, if the spread is 80 cents, there's a good chance on the next candle you're going to get stopped out of your trade. So we have to be mindful of that. This is why we also have to always be mindful of our max loss, right? Like I said before, we have to decide how much we're willing to lose per trade, per day, per week, per month, per quarter, per year, right? So I know when I first started trading in the beginning, I didn't have good risk management. I was risking $100 on one trade, $200 on another trade, $500 on another trade. And I was losing, and I was losing badly. And my losses were all over the place. Now, as I got better, as I became more experienced as a trader, I was able to get my risk management under control. And once I did that, once I proved that I could win at $100 per risk on a trade, I moved to $200, and then I moved to $500, and then there's times where I will actually risk up to $1,000 on a trade. But if anyone who knows me knows I hate to lose. So if I lose $500 or $1,000 on the trade, my day is shot. I'm ruined. I'm not good for anything. I don't want to talk to anybody. I don't want to eat. I don't want to do anything. All I want to do is study and figure out how I can fix my screw up. Because let's face it, when you lose a trade, it's because you did something wrong, right? You made a wrong choice, whether you made a late entry or you got out too early or you exited too late. Again, it's all on us, right? We have the ability to control what we do. We control how much money we're willing to lose, and we're willing to control what kind of a bad day we're going to have. If $50 will crush your day if you lose it, this is probably not the thing for you. If losing $200 in the day will crush you, then you know what? You lose $200, that's your day. That is over, right? Or you lose 150 and you're okay with that. But again, you have to be mindful of what you're willing to lose. It's like jumping out of an airplane, right? You're sure your parachute's packed correctly and it's going to work when you need it. It's the same with trading and risk management. If you do not have a sound risk management plan, I could give you the greatest trade in the world and you will bungle it because you'll probably not be correctly position sized for the trade. 2, you won't have good risk management because you won't know what you're actually risking, so what you stand to lose on the trade, and of course, without good risk management, I cannot save you from yourself. So the next type of risk we must be aware of is the distance from the stop loss to our profit target. As I've said, it's imperative you understand your max loss on the trade. Success is not being right 100% of the time. Success is actually learning to cut your losses when you're wrong. We are always looking for 2-to-1 reward to risk ratio or better on every single trade we take. We don't enter a trade risking 10 cents expecting to make $6. That would be crazy. It happens, but it's the exception rather than the norm. So when we go into a trade, we also don't want to risk 10 cents and only want to make 10 cents because that would give us a 1-to-1 reward to risk ratio. Now, if we lose a trade, then we need to win a trade to just break even if we're doing 1-to-1. But if I'm doing 2-to-1 or better, I have the opportunity to come out ahead even if I have a trade where maybe I break even. Right? So again, we have to put ourselves in position for good things to happen to us. Luck does not happen to you, right? We put ourselves in situations where luck can assist us. Luck helps the man who helps themselves. So if we put ourselves in a position for a 2-to-1 or better reward to risk ratio, we're in position to get a 3-to-1, a 4-to-1, a 5-to-1. I've had trades where I've gotten a 48-to-1 reward to risk ratio. That means I made $48 for every dollar I was risking on that trade, and it was all profit. So when it comes to risk, we need to learn to cap our losses. Imagine that all the winning trades that you took, you made $100, and all the losing trades, they were $10. You would only need to be right 10% of the time to cover the losses. Trading is like ice skating. When you start out, you know you're going to fall on the ice. You have to learn to fall in a controlled way so you don't end up seriously hurt. Trading is no different. When you learn risk management and you start capping your losses, you're preparing yourself for the times when you do lose, and you're going to lose. Make no mistake, you will lose more than you would like, more than you're comfortable with, but you need to get comfortable with taking losses, right? So that's preparing yourself in a controlled way so you don't end up seriously hurt or broke. We have to always know what we could lose on a trade. If you don't know what you could lose on a trade, expect very bad things to happen. Always know the potential risk so you can determine the value of a trade. We must always determine if the juice is worth the squeeze. It is not a trade until you know what your max loss is and what your potential target is. If you don't know either, you're gambling. You're not trading, you're gambling. So let's turn our attention now to the risk to reward ratio. Some refer to this as your profit loss or P&L ratio. We're always looking for a 2-to-1 minimum or better reward to risk ratio. To be successful day traders, we must have a minimum reward to risk ratio of 1-to-1. To be successful, we must have the minimum of 1-to-1. This means our losses are smaller than our winners, or worst case, they're equal in size. Your P&L directly relates to the percentage of success required to be profitable. Know your stat. You must know your average winners and losers. You must always be striving to improve your win ratio. You need to review your trading journal. Small adjustments can amount to increased profits. If you look at your trading journal and you look at the past trades you've taken and you see that maybe your stop loss was 10 cents, but again, you're winning 100% of your trades or even a really high percent, maybe you could tighten your stop loss and maybe pick up an extra 5 cents per trade, right? But if you see that you're getting stopped out a lot, right? Say you take a pattern or a certain pattern and you unsuccessfully win that trade very often, right? Maybe you have like a low 30 to 40% win ratio on it, right? Maybe you're putting your stop loss too tight, but looking over your stats, seeing what patterns you trade well, which ones are most profitable for you, you can make little micro adjustments like tightening your stop loss, or maybe you see that a certain pattern works great at a certain time of a day for you, right? So what I trade well, you may not trade well because I have more experience trading certain patterns at certain times of the day, but I also know which ones work with certain stocks better. So as you look at your trade journal and you review them, you'll be able to see the patterns that are emerging in your trading style and in your trading history. So if you're conservative and you give yourself an extra 5 cents on your stop loss and you see that none of your trades would have been stopped out, tighten your stop loss a few pennies, right? It can make a humongous difference. If you see your targets were met and exceeded on your winners, give yourself an extra 5-10 cents extra before you sell. If you can get an extra 10 cents on 1,000 shares, you're picking up an extra $100, right? So again, don't turn away free money, especially if you know that if you held it for just another moment or two or another 5-10 cents, you can pick up an extra $100-200 on the trade, then do it. So as I said, with our 2-to-1 reward to risk ratio, we always want to take trades that give us the chance to make double our risk. Where if we're going to risk $100 to make $200, we risk $200 to make $400, and so on. Always ask ourselves if we are in a 2-to-1 or better trade. If we continually put ourselves in the position of 2-to-1 trades, we're putting ourselves in positions for 3-to-1, 6-to-1, or even 25-to-1. So remember, if a stock moves $2, it's unlikely we're going to capture that entire move, right? We won't be able to time the top and the bottom. But if we expect that and we figure in the dollar move into our reward to risk ratio, we can capture our target and then some. So again, if we're expecting to make $1 on the trade, we're probably most likely risking 50 cents. So if we're risking 50 cents and we get that dollar, it doesn't matter if the stock went to $2 or to $10 or, as long as we get our reward to risk ratio, that's the name of the game. So when we talk about risk management, we have to get good at being wrong. We're taught since grade school to always be right and to get the right answer. We need to learn to be good at being wrong. Take a lot of small losses. I'm not saying take losses on purpose, but again, take some small losses. Small losses early may seem discouraging, but it's going to help you with learning to control your emotions. If you're losing your composure on a $25 loss, I can only imagine what's going to happen if you risk $200 or $500 or, God forbid, $1,000 and lose. If you can't control your emotions on $25 loss, you're not going to be able to control it any better, and it's going to be far, far worse if it's much higher. And remember, a a trade that you take that you would have lost $25 on is still the same trade that you would have lost if you had risked anything else, right? So the size of the risk that you're taking isn't going to make that trade any more successful. So we always want to set our stop losses as tight as possible. I'm not saying to set it right on something. Like if the pattern says put it below the 9 EMA, we're not going to put it right on the 9 EMA. We're not going to put it above the 9 EMA. So again, we want to set it as tight as possible, but we don't want to get stopped out. So if you find that your trades are getting stopped out quickly, right, or you're getting stopped out all the time, we're putting our stop loss too close. So as soon as the setup doesn't feel right, bail out. Who cares? Again, you get into a trade and it doesn't feel right. It doesn't feel like it's doing anything. Maybe it's going sideways. Maybe it's just, you're just like, okay, this isn't, I thought there was some momentum in it. I thought it was going to run and it didn't. It's cool. Get out of it. Who cares? It's one trade. Right? It's one trade. And if you haven't lost any money on it, right? If you're breaking even or you're just right around maybe a couple bucks or whatever, big deal. I would rather spend $5 loss or $10 loss or a $25 loss just to get out of a trade that's not working or not doing anything. Because remember, as day traders, we have the ability, right? We have the strength and the advantage of being able to be more efficient with our capital. So we don't have to be, if a trade's not running and it's not working, get out of it. We can find another trade that's working somewhere else. Why stick into a trade that's going nowhere? Sometimes you're going to sell the stock for a small loss and the stock's going to turn out and run. It happens, right? You think, oh, the stock, hey, man, it's not going to run. As soon as you sell it, the thing goes up $5. It happens. Other times you're going to sell it for a small loss. You're going to be like, oh, the stock ain't working, and the stock's going to tank. And then you're going to be like, wow, oh my God, I'm so glad I didn't hold on to it, because you would have taken an even bigger loss. There's been times where I've had a stock where the setup didn't feel right. I'm like, well, I'll hold on to it. Maybe it will run. It will do something. It did. It went down. And all of a sudden, I could have got out when I said, hey, it was only $20. No, I ended up losing $100, which was what my risk was on that trade. But because it didn't feel right, I didn't trust my instinct. Once you start learning to trust your instinct, if it doesn't feel right, get the hell out of it. So let's talk about breakout or bailout. A good trade is one that works right away. In my short-term trades, I constantly look for trades I get into to work immediately, right? My best trades are going to go green almost immediately, and they hardly ever go red. If a stock doesn't move the first few minutes, I bail out. If it works out later, then I'll get back in. But for my longer-term day trades, I'll sit with a small loss for a small amount of time to allow the setup to work, right? So for my short-term day trades, 15 minutes or less, it's more like scalping, where I'm looking to capture maybe 20 cents or a little bit more. For my longer-term day trades, the ones that I hold 15 minutes or more, that's where I'm looking to capture dollars. So let's turn our attention to determining our profit targets. We know how to set our stop loss, right? But how do we know what target to sell at? Your profit target should always be a minimum 2 times your risk. Look at the chart to determine if your target is realistic. If you scale out of your trade, sell half your position at 2 times your risk, and then raise your stop loss to your buy price, right? So you're locking in. So even if it reverses back, you're not losing anything, right? You're not even risking any money on that. Then you're going to sell your next quarter into the spike, and then you're going to raise the stop loss up to the first sell target. Then we're going to look for signs to sell the last quarter of our position. So let's talk about trading halts, because eventually you will experience this. Stocks can be halted and paused from trading for several reasons. During halts, traders cannot trade the stock in any way. Halts can last from anywhere from 5 minutes to hours or even days. So the first type of halt we're going to talk about is a trading halt, right? Which is news pending. Also, I think the code is T1. A news pending halt is when a company requests the stock be halted while they release news. This can be good or it can be bad. When trading reopens, the market reacts quickly to the news. Sometimes stocks move quickly based on rumors, so the company comes out and they respond. I remember a few years ago I took a trade. I can't remember what it was. I think it was Slack or something, and there was a rumor that IBM was going to come out and purchase them, right? They were going to buy the stock. And I went and took a really, really large position that morning, and all day long, right? The news was out there, the rumors out there, the stock was heavy, it was sashaying around, right? People buying, selling, people driving the price up. I think it went from like 20 and it got up to like 30, maybe even a little bit higher. And then I would say about 30 minutes before the end of market, right? So about 3:30 in the afternoon, the stock gets halted. So we're thinking, okay, so here's going to come the news, right? The news is going to be IBM is purchasing Slack. And sure enough, it came out. And then the company, it went into actually past the end of the trading session where it came out and they said, no, that's a rumor. It's not going to happen, that they're going to continue working with IBM, but they're not being purchased. And all of us were trying to dump our shares in the aftermarket hours, which you'll find that trading in the after hours, it's not as liquid as it is during the actual trading day, right? So you can trade and you can put your shares out there, but in the afternoon, the aftermarket, it's harder to get people to want to pay your price, what you're asking for. So I was really angry that day, but I also knew that with that trading halt, I was kind of screwed when we came out of it. If it wasn't good news, I was going to take a bath. And luckily, my profits were up, so I got in so early that day that I didn't lose my shirt. But there are some people that kept buying as the day went on, and they kept buying at a higher price. So in the morning, they may have said, hey, $20, yeah, not worth it, right? But then when the action came in and they went from 20 to like 25 to 26, some people are like, oh, I don't want to miss out. They got all this, what they call FOMO, right? Which is the fear of missing out. They jumped in and they started buying the shares at 26, 27, 28, and then the halt happens. So think about being the last person to buy your shares at 28, thinking that, man, this news doesn't come out and I'm going to make a bundle. And then it comes out and it says, sorry, we're not selling ourselves. So, and then of course the stock tanked. It went from 28 down to 24, almost lickety split. And that's called bag holding. You don't want to be the bag holder. Let's talk about the H10 SEC halt. An H10 SEC halt occurs when the SEC suspends trading for a particular stock. It happens a lot for penny stocks, and it also happens to companies that are suspected of promotion or fraud. A few years ago, we used to trade this stock called Luckin Coffee, right, which is this Chinese coffee company. It's supposed to be like the Chinese Starbucks, and they were cooking their books. And then when the SEC kind of caught wind of it, right, all of a sudden, everyone who had positions, which I actually had a small position at the time, it got halted. And then it was halted for like days and weeks. And frankly, we ended up getting stuck with the shares. It was horrible, right? So we have to be careful. So when the SEC halted, it's because there's either suspected fraud or there's some kind of chicanery going on, and they just stop it so other people don't get in there and lose money. So let's talk about the limit up, limit down, right? Which is the LULP. A limit up, limit down halt occurs for stocks above $3 and that move more than 10% in a 5-minute period, right? These stocks, they're going to experience what they call a circuit breaker halt for volatility. It's not uncommon to see a stock that maybe gets some news. Maybe it's a bio stock and it's entered a stage 3 testing and people are like, yes, this thing's going to go to the moon. And this is where stocks will go parabolic. A parabolic stock actually has a greater chance of being halted, especially ones that move uber quick, right? If they go from let's say from $5 to 15, it's going to have halts on the way up. There's one stock, I can't remember the name right off my head. A few years ago, we all got into it and it was crazy. I think it was BPTH. And this stock was, it kind of meandered around for a while and then it kind of went up to like 18. And this stock got all the way, I think, up to 70 something. And literally, I had bought at around 25. And this stock went up and it kept getting halted on the way up. Every time we would come out of the halt, right? Every time the halt was lifted, I kept fearing it was going to go down. But then it kept shooting up and shooting up and shooting up. And every time I get ready to put my order in to kind of take my profits, which was a lot of profits at the time, I couldn't get my order in fast enough. Right, I couldn't get it in fast enough while the stock was live. And then when the flush came on the same day, every time it went down, it halted. The stock would come out of the halt, it would be, let's say it was at 70, and then all of a sudden it's at 60 and you're in a halt. Then you come down the halt and you go from 60 down to 54 and you're in a halt. And then it goes from 54 down to 50 and now all of a sudden you're in a halt. It was almost impossible to sell your shares, and I was getting a lot of fills that were well below what I was trying to sell it for. So I was very happy to come out profitable on it, but there were some people that thought, man, this stock, it wasn't a good deal at 25, but it's a great deal on in at 70. And then all of a sudden the stock starts flipping down and they can't even unload their shares. They're having just as much trouble unloading their shares as I am myself, and I'm in the profit and I'm freaking out. And can you imagine having a sizable amount of stock that's $70 per share, and it's dropping so fast that you can't even get an order in to dump the shares that you bought at the top. Right? It's crazy. So you got to be mindful of the limit up, limit down. When a stock is halted, you have to pay more attention to the price action. So there's a good chance that every time you come out of a halt, it's a 50-50 shot that it's going to go up or it's going to go down. Sometimes it will work in your favor, but you need to be mindful. That's why we always want to be laser focused on our stocks. That's why we don't take a day trade and then walk away and go get a burger or go get a cup of coffee or use the bathroom. When the second that trade is going, you're laser focused on it, because if the halt happens, you need to be ready to respond. And we also have the indices, limit up, limit down, right? So this is like the S&P, the Dow Jones indices. They have different criteria for their limit up, limit down, right? And it's like 7%, they have a halt, and then 13%, they have a halt for a longer period of time. And then I think 20%, they actually shut trading down for the day. And if you remember back during the 2020 pandemic for COVID-19, there were multiple times that the entire market was shut down for the day. Like there was times where we had a 7% halt, and then another 7% halt, and then I think it was a 13% halt, and then we all just got shut down for the day. So again, when you experience those things, like there's nothing you can really do because we're all in the same boat. But we have to always be mindful of where the market is. If the market goes up way too fast, sure, it might sound great, we're making some money, but if there's a halt, you can't trade that stock. So no matter how profitable that stock is at the time in your folder for your positions, it doesn't matter until you can actually complete that trade and take your profits. Just like if the market's going down and it's halted and you have a loss and you're trying to get out of it, well, there's nothing you can do other than wait for the market to go back to functioning so you can get out and limit your loss. So we need to talk about fear from preventing you from following your trading plan. If you're a scalper, this is a short-term trade, right? It's not meant to be held for 15 minutes or longer. It's meant to be to get in and get out and take your cash while you can. If you're day trading, you don't want to turn it into a swing trade, right? We don't want to average down. And when I say average down, that some people will buy, let's say they buy X amount of shares at $10, right? The average cost basis for their trade is $10 per share. But let's say the stock goes down and all of a sudden it goes down from 10, let's say it goes down to 8. So they go, okay, well, if I bought X amount of shares at $10, I can buy the same amount of shares at $8 and have a lower average cost basis for my trade, which is technically true. So let's say you bought 100 shares at $10 and then you bought 100 shares at $8, right? Your average cost basis is $9, right? So you're still spending $1,800. But again, the chances are they do that thinking that if the stock goes back up, they're going to make extra money. And really, you're not. What you should have been doing is you should have waited for the stock to get to a point to where it bottoms out, right? Where it finds its bottom. Let's say $8 is its bottom. Well, then you would have been better buying your 200 shares at $8. And if it goes up $2, man, that's $400, right? So again, don't average down. It's fool's gold. You think at some point I'm going to keep buying and averaging down and it's going to go back up. All you're doing is just adding more losses to that particular trade. Also, we don't want to add position to a bad chart pattern. If it's bad, right? It's like going into your refrigerator and taking a swig of milk that has gone bad, right? Well, do you take another drink? No, it's bad. Why would you take another drink? Right? It's already showed you that it's bad. Same thing. If a bad chart pattern is occurring or has emerged, believe it, right? If it tells you it's a loser, believe that it's a loser. Don't add to it. Most traders who take big losses or they hold their trades for days or weeks, they never intended to hold it longer than for a day trade. But because the trade went the wrong way, their ego, right? Their ego prevented them from cutting their losses. Their need to be right and to be right all the time prevented them from saying, this thing is a loser, get out, right? It happens. Some people end up in really, really bad marriages for a long time because of that, right? They go, oh, well, it's not that bad. Maybe they'll get better someday. And then they never do. And they're like, man, next thing you know, I'm 35, 40 years down the road. I'm still married to the same miserable person because I thought it would get better, right? Just don't do it. Put your ego aside. If it's a bad trade, chuck it, right? Find something that's good. Find somebody that's going to treat you well. Find a trade that's going to love you back. Taking small losses, it's part of the game. Trying to hold it just to make it a winner, it's greedy and it's foolish, right? Like in the beginning, that was my whole thing was I didn't want to lose. I'm a very competitive person. I would be in a trade and I would hold it for days going, well, you know what? If I hold it and I make some money on it, whether it's $50 or $100, it's still a win. No, it's not. Because guess what? I had dead money. I couldn't do a damn thing with the money I had, right? It was all tied up in this one trade just so I could say I was right. I made money, but I didn't make what I missed out on trades I could have taken that made me way more than that. So again, once I adjusted the way I approached and I attacked the market, then guess what? I cut my losers because it's a loser, right? If you tell me you're a loser, you tell me you're a liar, I'm going to believe you and I'm going to treat you as such, right? If a pattern shows me it's a loser, I'm out of it, right? I'm going to go find me a winner, right? I want to hop on board with the winner. So again, like I said, small losses, they're going to turn into bigger losses, or more importantly, it's less capital and missed opportunities on another trade. Do not get FOMO, right? It's the fear of missing out. So we talked about the impulse to double down. Some traders, they can buy anywhere, add more, and make their way out of a bad trade being very profitable. This is not you. This isn't me. Unless you're trading with $1 million or more, right? This is a poor way to trade anyways, right? It's bad habits. Drown out the noise of social media braggarts who hit the huge winners, right? Oh, I pulled in $5,000. Oh, I pulled in $64,000. There's one trainer who, I won't say his name, but if you have been on YouTube before, this guy constantly says, oh, I made $49,000 today. Oh, I made $62,000 today. Oh, and yet they never have the receipts to prove it, right? So again, people get on social media and they'll brag about how much money they make. Take all of the braggers with a grain of salt, yours included. Me, listen, I make good money and I'll tell you what I make. Don't believe me, right? I'm not telling you to believe me. I'm not telling you to not believe me. I'm just saying that what I make, it's none of your business. What you make is none of anybody else's business. It's your business. So how much someone else makes is none of your business. Being the best profitable trader you can be, and that is your business. Mind it. Add to your winners, not to your losers. We want to be in the position of adding to our winning trades, right? Winners have already proven that they can win because they're doing it. Losers have already proven that they can lose because why? They've lost, right? Many traders choose to average into their positions. You may start with a smaller position size, expecting the trade may lose, and then add more shares at a lower price, right? That's called averaging down. That is dangerous. If the trade is winning, look for additional spots where you can add, right? You can add to your positions when it gets higher, right? So new patterns emerge. Maybe you have a stock that has a breakout, right? A flat top breakout. And then all of a sudden it goes up. Now you've got a bull flag. That's another pattern that you're going to learn. I would add to that, right? That's not averaging down. That's adding to a winning trade. That's taking a position that's already being shown that it's strong, right? But if you're losing money on a stock and then you're like, well, geez, I'll take 50 shares. And then if it goes down, I'll buy 100. Okay, well, you're still averaging down. It's still a losing trade because why? It's losing. It's losing. So I want to trade. I will invest in a winner every damn day of the week, right? You could tell me a stock is going down and it's going to go down to 5 and it's going to go back up to 10. I will not believe you, right? Because again, it's showing me it's a loser. Just because you think it's going to happen or you guarantee it's going to happen doesn't mean it's going to happen. But if a stock is winning, it's proving it's winning and it's probably going to continue winning, right? And if it doesn't, I have the risk management to prevent myself from losing. Another thing that we need to be mindful of when it comes to risk management is revenge trading, right? Or as I like to call it, quicksand, right? The second major cause of most failed traders is revenge trading. This happens when a trader goes red and instead of walking away and starting fresh the next day, they average down or they start taking wild trades to make up for the losses of the earlier in the day. When you start trading emotionally, logic and training goes out the window. I'm going to say that again. When you're emotional, you do not think. Right? You don't think. Think about when you're angry and you're in an argument with somebody. You're not thinking of a solution. You're thinking about how you can win that argument. Same thing with trading. When you start being emotional when you're trading, you don't use logic, right? I've lost 400 bucks. I've got to make 400 bucks back so I don't have to feel like I'm having a crappy day. The training I teach you, it's going to go out the window because all of a sudden it's like, well, if I follow his method, if I follow his pattern rules, well, I may not make that money back today. And it sucks, right? Your ego says, man, we've got to get this back. So instead of getting base hits, right? Most of these traders, they go out and they start swinging for the fences, right? So again, maybe you make a couple outs early in the trading day, and all of a sudden you're like, you know what? I'm going to go out, and you're going to start swinging because you're going to try and make it all back on one trade. Like a fool, right? So you're going to start swinging for the fences. Bigger swings means bigger misses, right? Bigger losses. You don't want these losses. So I always say, think of this being stuck in quicksand, right? Your loss is the quicksand. The more you struggle to get out of losses, the faster you're going to sink. The more losses you're going to pile up. So listen, when you lose, take a deep breath. Be calm. Embrace your loss, right? You did it. You made the loss. You made the choices that got you into the trade. Whether it's a winning trade or a losing trade, it's all on you, right? It's all on you. You own it. If the losses cause you stress, take smaller position sizes, which will give you smaller losses, right? So you have smaller risk, right? You ultimately decide how much money you're going to lose on each and every trade. If you lose $100, that's your own fault. If you lose 500, that is your own fault. So you have to own each and every loss. You cannot celebrate your wins without embracing your losses, because through your losses, that's where you're going to learn. That's where you're going to develop the discipline, right? If it hurts and it hurts bad, you're going to be a little bit more mindful. If you said, you know what, this thing's going to run, maybe let's say that the pattern says you're most likely going to get a $2 profit target, but you're like, I'm going to be greedy today. I'm going to wait for this thing to go $10 profit. And let's say all of a sudden it goes to 3, and then it reverses back, and now you break even or you take a loss, right? Now you're mad. That damn stock, it didn't do what I thought it was going to do. You're right, because you don't control it. You control you and you alone. So again, if you lose $100, it's on you. We have the ability to determine how these losses will affect us, good or bad. So let's talk about the fear of loss, right? The fear of loss, it's horrible. The fear of loss and the fear of missing out are two of the biggest emotional drivers of traders, right? Greed as well, but for an entirely another reason. If you're afraid of losing, you will hold a loser too long. You will. If you're afraid of losing money, you're going to hold on to it because you don't want to lose money, and it's going to be a bigger loss. If you're afraid of missing out on a stock that's running, you will chase that stock and you will overpay for it and you will lose money. You have to learn to trade without emotion. You have to almost trade like a robot, right? It's hard, but it's necessary, or you will lose. You'll lose. Fear serves as nothing more than a distraction. If you follow the rules of the pattern and you practice good risk management, you've done all you can do to put yourself in the best position for success. If you let fear dictate how you trade, you will be a failure at trading. I hate to be the bearer of bad news. You will fail. You have to not care, right? You have to learn not to give a crap. Right? So yes, it sucks when you lose. I feel crushed when I lose, right? It's just my personality. I'm a competitive person, played sports my entire life. I used to be a coach for high school football. So again, when we lose, I hate it, right? I hate it because it means I did something wrong, right? But that's why I hate it. I hate it so I can get better, right? Most people, when they lose, they are emotional, right? They don't stop thinking like, what did they do wrong? They're like, why does bad things happen to me? Nothing. Bad things happen to you because you made a choice to make something bad happen to you, right? So quit. Don't worry about the stocks that have already run. If it's running, you're late to the party, right? If you see a stock has run, you're like, man, I should have got in on that. It's too late to get in, right? Don't go chasing it, because if you thought it was a bad deal or you didn't think it was worth taking at 20 and it's now at 35, well, guess what? You're going to be paying a premium. The people that already won the trade got in at 20. They're selling you their shares at 35. At 35, you're thinking, well, I'm going to get another $15 run. No, you're not. No, you're not. It's probably the top. It's probably going to flip over and flush. You might get an extra buck or two, but you already missed the move. The trade has already occurred without you. The train left the station and you're running after it, right? And the train's pulling into the station for the next year to be able to sell it. And then you catch up to it. And then you want to hop on the train, but it's going to go reverse. It's going to go backwards, right? It's going to take you right back where you ran from. Just stay away from it. Do not let fear dictate you. So let's talk about fear of missing out, right? What we call FOMO. It's natural when we see a stock making a big move that we want to jump in and chase it. That's our nature. It's the dog in us, right? We want to chase that car. Most traders see a stock running and automatically assume that once they get into it, the stock's going to keep doing its thing and keep running. But then they start calculating in their head how much money they missed out on. Oh, I could have made a $2,000, or how much money they can still make. And they don't stop and think that if their entry was the right one. Just because you can get into a stock, which you can get into basically any stock you want, you can buy anything that you want, is it the right one? The truth is, once you see the stock running, you've already missed the entry point. Like I said before, the race started without you, and now you're trying to play catch up while everyone else had a head start. Take a deep breath. Be patient. Wait for the stock to pull back. Maybe give you an entry. If it does, you will already have a defined target of where the stock recently was, right? So if you see a stock running, it goes from 20 to 30, and the stock pulls back to 25. Well, you know the stock can go to 30, so maybe you get in there and maybe you get a $5 rip. But everyone else who caught from 20 all the way to 30, they've already played the game. Their game's over. They've already run that race, right? Now you're hoping that the race is not over. But take a deep breath. If it doesn't, big deal. You missed it. So what? It sucks, right? Because you start thinking like, man, if I just would have been smart enough and take this trade, I could have made all this money. If that was the case, I would never trade, because there's so many stocks that were on my watch list each and every day. And there's days where I have stocks on my watch list that were the winners, and I had chosen to take other trades that I thought would be better winners, right? So it's like I'd gone to a dance, and there was a chick who was there who wanted to dance with me, and I knew she was my girl. I knew that she was going to fall madly in love with me. But then I happened to see out of the corner of my eye this other girl who is pretty beautiful, right? Pretty hot. And all the guys wanted her. But she wants to give me a chance. And I'm like, well, you know what? I know I did all my research on you and we were good, right? But I'm going to take my chance on this other girl. And then what happens? The other girl lets me down, disappoints me, shuts me out, whatever, freezes me out. And all the time, I could have been better off with the other girl. But when I go back to the other girl, guess what? She's already found somebody else to be into, or she already found somebody else to dance with. And guess what? It's the same thing with stocks, right? You might be watching a stock and you might be ready. You might have your mentally preparedness for that stock, how I'm going to play it, what my target is. Like you'll sit and spend an hour studying the chart and thinking about, you'll look back at past moves. And then when it comes time to play that, you're like, oh, yes, this nice bio stock, it looks very, very sexy. And then you get it, and what happens? Bam. Good stocks will always give you multiple opportunities to enter a trade. If you miss a stock that breaks out, okay, that's fine. You don't have to chase it. Just wait. If it's a good trade, it's going to give you another chance, right? If it, like, again, to go back to my analogy of the girl, if I miss the dance with the first girl, I'm just going to wait my turn, right? I'm going to wait for it to come back. If it's worth it, if it's worth investing my time and effort and energy, it's going to give me another opportunity to get into that trade. So let's talk about social media traders, right? And how they never lose. Social media traders, they always post pictures of their winners and hardly their losers, right? If ever. Most selectively post trades and show the world how smart they were at taking this trade. But where are their losers, right? Ask yourself, what's the motivation for bragging, right? Some people will get on there and they'll post something from their paper trading account where they took a really humongous trade and I made $72,000. They're going to lie just for attention. It's sad, but it's the world we live in, right? We live in this kind of world where people have to project something that they're not because they want to feel better about themselves or they want to be the envy of other people. These people are more worried about social acceptance and their image more than they're about their profitability. I could care less what anyone thinks of me. Look, I love you all. I'm glad you purchased this class. I care less what you think of me. What do I care about at the end of the day? Am I a profitable trader? Because that's what I can control. I can't control what others think of me, but I can control how profitable of a trader I am. Some will be holding a position in a loser stock, and they're going to attempt to try to create this hype or this buzz so the price goes up so they can minimize their losses. Do not help them. Let them drown. Don't let them distract you. There are some good traders out there to follow, but you have to know who they are, right? They know what they're doing, but you have to know which ones they are to follow. But this number is extremely small. So let's talk about improper position sizing. This is the number one reason that traders blow up their accounts. They take too big of a position size without good risk management. It's one of the dumbest things a trader can do, regardless if you win or lose on a trade. For every wild gamble trade that you take and win, you're going to lose badly 5 other times. And I promise you, those losses will hurt you way worse than how good that win felt. Make it a habit of trading high quality setups, right? That's setups that have low risk, high probability of meeting your reward to risk ratio. Stick to the Parabolic method of risk adjusted size positioning, and your losses will always be predictable. Because why? Like I said, you have determined what that number is going to be before you take a trade. If I decide all I'm going to do is risk $100 in this trade, and I put my order in and my stop loss is correct, and I have the number of shares that I can purchase that match up with my stop loss and the amount I'm risking on the trade, I'm going to know that if the trade goes south, I'm going to lose exactly what I decided, which was at $100. Give yourself some breathing room. My goal each and every day is to start off green, give myself a little bit of breathing room, right? Get a couple wins under my belt. If my first few trades are green, I can relax so much easier and maybe even take some trades that don't have the best setups, right? I can be a little bit riskier because if I have wins in my pocket, I can afford a loss here and there. With this room, I can afford to be a bit more aggressive in my trades, and I can turn a good day into an even greater day. In contrast, if I'm red on my first few trades, should I be more aggressive to recoup my losses? No way. Right? Giving myself some breathing room will impact how I trade that day. Less stress, less need to try to force a winning trade, right? Remember, that's that revenge trading I was talking about. My daily goal every day is to be finished trading by 11 a.m. If I fail to meet my goal, I'm tempted to hang around all day hunting for other trades. If I have a bad morning, that is all it is, a bad morning. There's no reason to make a bad morning into a bad day, or worse, a bad week, a bad month, a bad year, or a bad life. So now we're getting to the nitty gritty, right? How we determine our reward to risk ratio and our position sizes. So remember, the reward to risk ratio is how much you're going to gain if the stock moves the way you want versus how much you will lose if it goes against you, right? Your potential gain and loss. So for example, you enter a stock at $10 and you anticipate it could go to $10.30. Your potential gain is 30 cents. If your stop loss is $9.90, you're risking 10 cents on the trade. So potentially your reward to risk ratio for this trade would be 30 cents, right? 3 to 1, right? So it's 30 cents, 10 cents, or 3 to 1 reward to risk ratio. So think about this. Say you take 1,000 trades in a year and you win 50% of your trades, right? So for 500 wins, you make $200 per trade, right? That's $100,000 in gains. But you also take 500 losses, right? And you lose $100 on each trade. That's $50,000 in losses. By winning 50% of the time, right? Being right 1 out of 2 times, you've made $50,000, right? Think about that for a minute. What other job can you get paid to make, $50,000 for being right every other day, right? Every other day, every other thing that you do is right 50% of the time. Any other job, you would get fired. You would get fired with a much higher ratio, right? You might do something right 80% of the time and you'll still get fired because you suck at the other 20%. Trading is the only job where you can be wrong more often than you're not and still be profitable, right? So think about that. You could be profitable by winning 50% of the times. It's amazing. So there are 2 different types of position sizing, right? There's the fixed position sizing, which is not good. And there's the risk adjusted position sizing, which is what we refer to as the parabolic trading method. So let's talk about fixed position sizing. With fixed position sizing, most traders use fixed amounts. Either they buy 1,000 shares of everything, regardless of the price, or they buy $10,000 of a stock. This is convenient, but it's also wrong. When you see a low risk, high probability trade, you're not going to be properly sized for the home run. You'll have the same number of shares as you would in a random high risk, low probability trade. So with fixed position sizing, right, this is why you shouldn't do it. Say you buy 100 shares of everything regardless of the price. Your risk will fluctuate based off of where you have to place your stop loss according to your pattern. You cannot control the maximum amount of risk you expose yourself to on each trade. For example, you buy 100 shares of Apple, right, with a $2 stop loss. You're risking $200 on the trade. Now you buy 100 shares of NVIDIA, right, and your moving averages dictate a $4 stop loss. Now, since you bought 100 shares, you're risking $400 on the trade. Your losses are not predictable. Now you buy 100 shares of GME with a stop loss of 50 cents, but now you're risking $50. This stock runs from 10 to 15. You make 500. But if you had used risk-adjusted position sizing and were risking $200 on the trade, you could have made $2,000, right? So this is why we don't want to use just fixed size. We don't want to use fixed costs. We don't want to, I only buy 100 shares of anything. I only buy 1,000 shares or $1,000 worth of anything because it doesn't have us properly positioned. All right, so with the parabolic trading method, right, also known as risk-adjusted position sizing, we can risk anything from 0.25% to 2% of our portfolio value on trades, with most trades around 0.5 to 1%. But here's the thing, risk equals entry minus stop loss multiplied by number of shares. So for example, if you're risking $200 and your stop loss required by your pattern is 10 cents times 2,000 shares, $200 risk, a 20-cent stop loss means you can buy 1,000 shares, right? And if you get stopped out, guess what? You lose $200 on both of those examples. So with the parabolic trading method, you need to determine just how much money you're willing to lose on a trade. You can determine the max amount loss on the trade by day or by week. The max amount is what you can lose before you feel like it would ruin your day, week, month, or even your life. $100, $200, $1,000. The amount you're willing to risk will determine the number of shares you can purchase for a stock. For example, you find a trade with a low risk, high probability at $10 a share. You think the stock can go to 13 based off of previous moves. You identify your stop loss at $9. So you're willing to risk $200 on the trade. With a stop loss of $1 per share, you can purchase 200 shares, right? So that's $1 your stop loss times 200 shares equals $200 risk. So if the trade goes south, you get stopped out, you lose $200. If the trade fails, you lose $200. If your stop loss is 50 cents, you can buy 400 shares. If the trade fails, you still lose $200. If your target is reached, you're going to make like $600 or $1,200 respectively. So this is why I like to use this risk-adjusted position sizing, because I'm in control on each and every trade. If I decide I'm risking $200 on trades, that's all I'm going to lose. So if I lose a trade, it's $200. If I win a trade, it's going to be $400 or more. Because why? I'm only willing to take trades that I can get a 2-to-1 reward to risk ratio or better. So new traders, they struggle with quickly calculating the position size, which is why they form the bad habit of just buying a fixed number of shares, right? It's easy. I'll buy 100 shares of everything. I don't care what it costs. 100 shares, 100 shares, 100 shares. I have taken the liberty to create a simple Excel spreadsheet that you can print out and quickly reference, right? Print it out, stick it on the wall, stick it in front of your computer. So all you have to do is quickly glance over. Right, you can reference how many shares you can purchase based off the amount you're willing to risk per trade and the stop loss required. On the left side, the first column is required stop loss for your pattern. The rows across the top is the amount you're willing to risk per trade. The numbers in the corresponding cells below are the actual numbers of shares that you can purchase. If you get stopped out, you're only going to lose what you're risking per trade, which is that top line. As you can see in this example here, this is an actual screenshot of the Excel spreadsheet that you're able to download. So you can see on the left-hand side, we have the stop loss, right? That's what the stop is. The column right there underneath there, those are all stop losses, then 10 cents all the way up to $1, and then it goes from $1 all the way up to 10. I actually have other spreadsheets that I use quickly because, again, I like to get in and out of a trade. If I got to pull out a calculator to calculate how many shares I can buy in order to ensure that I'm only risking X amount of dollars, my trade's running while I'm sitting there fiddling with a calculator, right? I don't want to have to sit there and think in my mind and do a math problem. I'd rather be in and out of a trade or into the trade as quickly as possible so I can maximize and get out and take my profit. So for example, let's say that we have a trade and it's required to have a 50-cent stop loss, and we're risking $300 on the trade, right? We go over, we can see under the $300 column, we can purchase 600 shares. Now, that math is pretty simple, but what happens when you have something that is like 30 cents. And now all of a sudden, you have to do $75 as your stop loss, as your risk, right? The math is not as quick, right? It's 250. So, or let's say that you have a 60-cent stop loss and you're risking $200. All of a sudden, that math gets a little bit more complicated to do quickly in your head, right? 333, we can look at a chart and we can just see, bam. And if you are consistently, right? So I would say as a new trader, what I want you to focus on, start with the $25 risk column, right? You're risking $25 per trade. All you got to do is focus on that. You can even print this out and then just cut out the first two, right? You got the stop loss and the $25. So that's all you got to do. All you got to do is look and see where your stop loss is, and it will tell you exactly the number of shares that you're able to purchase with only risking $25. Again, same thing. And then once you get profitable at 25, then go to 50 and so on and so on. So good risk management practices are, one, having good personal patterns, right? Finding high quality setups. That's the first thing you need to do. Second, you need to use proper position sizing. Third, picking high probability, low risk trade. They are essential to good risk management. And four, your ability to ride out winners, right? We look for reasons to sell. We don't look for reasons to hold a stock. We look for reasons to sell. So let's talk about the reasons to sell. The first reason we're going to sell is our profit target is reached, right? If it reaches our profit target, we want to go ahead and sell. Second, if the stock price reaches a level of resistance or support. So remember, resistance is the stock isn't going to go any higher and it starts retracing back down, and support is the stock's not going to go any lower. So if I'm longing a stock and the stock price reaches the current resistance level, I may be thinking about either one, closing my position just so I can lock in the most profit I can, or two, I would do what I normally do, which is scale out of my trades. I might sell half of my position at that point and then raise my stop loss up to my buy price. So if the stock reverses back, I'm not losing any extra money, right? So I no longer have any risk. So again, and if the stock continues to go further, well, then I'll look for new reasons to sell out. Same thing with support. If I'm shorting a stock and the stock is, if it's shorting and it comes back up to the support level, I do not want to continue shorting that stock. So I'm going to go ahead and cover and get out. The third thing we need to think about, if a stock gets overextended or parabolic. If a stock goes from 20 to 30 up to 45, listen, you can try holding it thinking that you're going to get $100, but you don't understand. You think $100 is the home run. No, the $15 move is the home run. Do not get greedy. In this game, I believe trading, the karma plays a big role in what we do. If you get greedy, karma will come calling and it's going to smack you down, right? If you get greedy, it's going to bite you in your ass. It will. It has done it to me so many times. That's why I learned not to be greedy. I don't need the whole home run move. I don't need to catch the bottom, time the bottom and hit the top, right? I don't need to time my entry and exit perfectly to maximize everything. I'm looking for the meat of the move. If I can make money on a trade, I'm happy, because most people can't even make money on a trade. So let alone try to time the top and bottom. Second, if a stock breaks under price support or through your moving averages, that might be a reason to sell, right? If your moving averages no longer support what your pattern is or what your price is, you might want to start thinking about, hey, the moving average is starting to curl over. It's probably going to reverse back. So it's not going to come back and you're going to get more money. It's probably going to flip over and then flush. So again, at that point, why would you want to hold? All you're doing is giving away profits. So your moving averages start curling over and curling down. Yes, you definitely want to get rid of that, right? You want to close your position. The trend of the higher highs and higher lows is broken. Remember, when we talked about uptrends and downtrends, when you have an uptrend, you keep making higher highs and higher lows. Well, once you start seeing that there's no more higher highs and higher lows, that's a pretty good indication that you're going to reverse trend. Why would you want to hold stock so you can sell it at a lower price? Get rid of it, sell it, bank your profits. And of course, if the stock breaks a trend line. So if a stock starts going backwards, right, maybe it goes from 10 to 15, and you've got a trend line drawn at 12, right? If it breaks below it, guess what? You want to get rid of it, right? You want to go ahead and sell it. Or if the stock is going up and you have a trend line, let's say for you're in a position and you see other patterns emerge like a bull flag and it starts breaking through there, you might want to scale out, sell off half, sell off a quarter, right? Don't sell up. I mean, you don't have to sell up everything. You can if you want. If you want to just have a one and done trade and be done and bank your profits, awesome. But if you want to maximize, you want to ride your winners, sell out half. Raise your stop loss to your buy price. So at the very worst, on the rest of your shares you hold, you're breaking even. You never want to start out big with your risk. 75% or more traders will put their entire account into one trade without having the proper skill level. These traders will accumulate losses much quicker at a faster rate than their skill level rises. So start small with how much you're willing to risk. For your first week of trading, risk $25 per trade. As your win ratio increases, right? So you start with your win rates much higher. So maybe you're winning 80% of your trades and you start making profits consistently, slowly begin to increase your risk to $50, right? Because a $25 trade that you win on is a $50 trade that you'll win on, all right? But if a $50 trade you lose on, you're going to lose on that same $100 trade or $200 risk on your trade. So earn your way by taking more risk, right? Earn your way to those risks. A losing trade at 25 is still a losing trade at 200. To be successful at trading, I'm going to tell you right now, it takes patience, it takes screen time, and it takes reps. Time is important. The goal is to get your skill level up as quick as possible while minimizing the losses to your capital. If you start taking $200 risks and you start losing 10 times, man, that's $2,000, right? And maybe it takes you 3 months to get comfortable enough to where you have the mind memory connection, right? The mind muscle connection, and you have the patience and you have the necessary screen time, right? You see thousands and thousands of charts, and then all of a sudden you start seeing patterns everywhere. I see bull flags, I see this, I see that. But as you start seeing more and more patterns, then all of a sudden, you have the capital to capitalize on that. But if you start thinking like, well, you start squinting at a chart and going, well, maybe that's a bull flag. It could be, I don't know. It could be a pullback. If you're asking and if you have doubts, you do not see the pattern, right? Or at least you do not see it well enough to master it. So the last thing you want to do is start taking willy-nilly trades where you're risking 200 shares because your idea is I'm going to rip $1 per share, and maybe you have 500 shares. Again, it takes patience, it takes screen time, it takes reps. This is a long game, right? This is the long ball. This is the long game. We're not in this to get rich quick, right? A lot of people think the stock market's where how you go and you get rich quick. Some people can, but they also have a whole lot of capital and they also have an understanding of what they're doing, right? For some people, for many of the people that have bought access to this course, you don't have the necessary experience. You don't have the necessary trading. And if you do, you've lost badly. And that's why you're here, to learn from somebody who is an accomplished trader who makes money on nearly almost 82% of my trades. And that's the ones that I take that I actually spend time on. I actually have a much higher win rate on other types of trades, about 90%. And that's what I teach in another course, which is value momentum investing. So as I referenced in the last slide, I said that we want to get your skills up to speed much quicker before you lose your capital. So you could have $50,000 plus no limited skills equals broke. $50,000 in no skills means you're broke. You could also have $0, but you could have a whole lot of accumulated skills and you're still broke, right? My job is to get your skill level from 0 to 10 as quickly as possible before your capital level goes from 10 to 0 as quickly as possible. So here's some tips on managing your winning positions. Cut your losses early and let your winners run, right? Like I said before, a losing trade proves it loses because it's losing. A winning trade has already proven to you it's a winner, so have some faith in it. When faced with profit, it's always good to book some. Put a stop at your buy price, and now your risk is managed to 0. It's a free trade. If you're up 3% or more and you're unable to deal with a position of strength, scale out, right? So you start freaking out going, oh my God, I'm making so much money. Scale out. Bank some profit. Put your stop loss immediately at your buy price to make this a no-lose trade, or use a trailing stop, which we talked about in the order types section. So use a trailing stop. If you don't want to sit there and micromanage, you're afraid you're going to run your stop too close, just put a trailing stop, right? It's going to be automated. So when the trailing stop gets hit, you're still going to be banking more profit. In bull markets, scale out of your shares, right? When I say scale out, that don't mean sell all your shares. If you have 100 shares, don't just sell all at 100 at the same time. Sell half, and then sell another quarter, and then sell the last quarter, right? So, for example, say you have 2,000 shares. You hit your first price target, sell out 1,000 shares. Then you raise your stop loss to your buy price. So now you got no risk in this trade. And then if stock goes up more, then you sell 500 more shares. And then you can get crazy and go another half of that, right? So you can sell 250 shares, and then 125, and then keep going half and half until the stock says, hey, here's your stop loss, you're done. And as you keep scaling out, keep raising your stop loss to the previous sell mark. So in this example, say I sold 1,000 shares at $10 and my stop loss was at 9, right? And then I bring my stop loss up to my buy price. So that way there, let's say the stock goes from 10 to 11. Well, now I'm going to bring my stop loss up to my original sell price of the first half, which was the $10, and I'm just going to keep scaling out. And at some point, the stock's going to stop me out, and all I'm doing is banking incremental profit along the way. I'm getting more profit than I would have gotten if I had just sold all 2,000 shares at a given price. If the stock is exhibiting serious momentum thrust after the initial sell, keep your trailing stop higher, right? Using the nearest pivot points or your support level. When the market is range bound, you have got to cut your winners quicker, right? So when the market's going sideways, your stock may be up and you may be having some profit, but it is nothing. It is very common for the market to kind of reverse back and just eat up any profits you have made. You may not lose a trade, but you might lose the profits that you worked hard to earn. Do not give back free money. So that's it, folks. We've just wrapped up the first of our 4 free comprehensive tutorials here that I hope has given you a taste of what it's like to navigate the exciting world of stock trading. If you found today's content insightful, first, give it a thumbs up. And if you're eager to dive deeper into this rewarding field, I have an incredible opportunity for you. Just below this video, in the description box, you'll find a link to my bootcamp course at parabolictradingbootcamp.com. Clicking that link will unlock an unprecedented opportunity for you to master trading patterns that have proven their worth time and time again. And here's the kicker. I'm offering to you this at a launch price of $97. That's over 60% off the regular price. I believe in empowering my students to succeed, not in perpetual subscriptions. So when you join my bootcamp, you get lifetime access with no ongoing subscription price. Now, you might wonder, how am I different from other trading educators? Well, unlike some of them who use their course fees to trade and profit for themselves, my main goal is to help you become independent and profitable in your trading journey. They need your money. I do not. I am a successful trader with or without your money. My goal is to share the knowledge and experience I have gained over the years in becoming a profitable trader and help others find their financial independence. Unlike other trading educators, I teach you how to trade the market up and down. Whereas others, they teach you 1 or 2 patterns to the long side, which is great if the market is strong and it's always going up. But that's not how the market works. You have to know how to play the market to the downside if you want to make money regardless of how the market is going. My focus is on providing you with valuable tips, insights, and real-world techniques, not just filling my own pocket. That's the Parabolic Trading Bootcamp commitment. So why wait? Start your journey to becoming a successful stock trader today. Remember, this offer isn't going to last forever. Make some extra money, take a vacation, supplement your income from your full-time job, pay your kids' college, learn to become profitable enough to quit your day job and trade the stock market for an hour or 2 each day, and spend the rest of the day with those that you care the most about. My friends, I want to share something with you that I believe truly sets the Parabolic Trading Bootcamp apart from anything else out there. I'm introducing a double money back guarantee. That's right, you heard it correctly, double your money back. Go ask other trading educators if they're willing to offer you the same deal. Some of them are too busy paying $3 million FTC fines for misleading their students. Others are focused on having you spend thousands of dollars for live bootcamp classes that are routinely canceled and take 2 months or more to complete. These same trainers then force you to pay $199 a month to join their chat rooms where they tell you what trades they are taking only to sell you the shares they are trying to unload themselves. This is how strongly I believe in the effectiveness of the proven trading patterns and rules I'm going to teach you at the Parabolic Trading Bootcamp. So here's the deal. If after 6 months of faithfully following our trading patterns and adhering to our rules, you haven't managed to double the cost of this course and profits, I will personally give you back twice the money you spent on this course. This is how much I believe in what I'm teaching you, and I'm willing to put my own money behind it. Are they? But here's the catch. This offer only applies to those students who have diligently studied the material, abided by the training rules, and reached out for advice and guidance when needed. If you ignore my teachings, dismiss the patterns and the rules associated, and you let your emotions drive your trades, you will not qualify for the refund guarantee. I'm here to help change your financial life, but you need to meet me halfway. You need to commit, learn, and adapt. I believe in you and your potential to succeed in training. Now it's your turn to take the leap of faith and join us at Parabolic Trading Bootcamp. So I'm offering a package that is absolutely packed with value. Here's exactly what you're going to get when you join me at Parabolic Trading Bootcamp. First, you're going to get over 18 hours of recorded video content updated with new examples weekly. That's a $19.97 value right there. Second, I'm going to provide you with over 20 proven profitable trading patterns to help you take charge of the market. 3, I'm going to give you examples to show you how these patterns are played in real time. On top of that, I have swing trading strategies that can help you earn while you're working your day job. And for those ready to take the plunge, I'm going to offer you day trading strategies to help you quit that day job and focus on trading full time. You're also going to have access to recorded live trades where you can learn directly from how I played a trade. You're also going to have access to periodic live bootcamp classes where you'll also have access to recorded bootcamp classes. I'm going to give you access to my personal TC2000 layouts and scans, as well as access to my Thinkorswim layouts and the scans. And most important, you're going to get the chance to quit your day job and achieve financial independence. That, my friends, is truly priceless. But that's not all. You're going to also gain access to our future courses on cryptocurrency, options, and Forex as they're released. But be warned, once these are out, the price of the program is going to go up. Now, you get all of this, a package worth thousands of dollars for the limited time launch price of just $97. That's more than 67% off the normal price of $297. $97 can change the rest of your life. I have students who paid thousands to learn from me, and it's changed their financial lives. It doesn't matter if you've been at the same job for 10 years, if you're a single mother, if you're a freshman in college. Taking control of your ability to read and play the stock market will bring you more success than just about any job out there. And you won't be limited to by salary or hourly wages. You won't be subjected to layoffs or downsizing. You will truly be in control of your financial destiny. $97 is what it costs for a typical date in a movie. Then it's gone. Take the same $97, invest in yourself, and turn your reward to risk ratio into numbers you could only dream of. Do not hesitate. Enroll today and embark on your journey to financial independence with Parabolic Trading Bootcamp.